The day I made my last mortgage payment, I sat in my car for 10 minutes, like a weirdo. I didn't call my mom. I didn't pop champagne. I just sat there in the silence. And the feeling wasn't what the movies promise you. It wasn't pride. It wasn't a sudden urge to climb a mountain. It was just quiet. This deep, unfamiliar stillness I hadn't felt in 15 years. That quiet, I realized later, it was the sound of a massive weight I didn't even know I was carrying finally hitting the pavement. But here's what nobody tells you. Most people treat the payoff like a finish line. They cross it, and then immediately fill the void with more junk. A $50,000 kitchen renovation they don't need. A new Lexus. A lifestyle that expands to eat every single dollar they just freed up. Fast forward 12 months? They're just as financially stressed as before. They just have nicer subway tiles. My name is Ryan. I study how money and psychology mess with each other. Specifically, the weird decisions we make at these massive turning points. And paying off a mortgage? That is the Super Bowl of turning points. Today, we're talking about what actually changes, mentally, financially, and practically. More importantly, we're talking about how to not blow it. Because the payoff gives you the key. But what you unlock with it, that's on you. Let's start with the part that actually blindsided me. It wasn't the bank balance. It was how it felt to stand in my own hallway. See, there's this low-grade anxiety that comes with a mortgage. You don't notice it because it never stops. It's just the white noise of your adult life. It's that subconscious hum that says, every month this massive number must leave your account. Or else. You're living in a house that, in a very real legal sense, is partly owned by a giant corporation that doesn't care about your feelings. One bad job loss or a serious medical disaster, and the roof over your head is a question mark. You aren't thinking about this while you're scrolling TikTok. But it's running. Always. It's like a browser tab you forgot to close 3 years ago that's slowly eating up your laptop's memory and making the fan spin. When that tab finally closes, and I mean really closes, when you feel the silence in your bones, it's disorienting. I've talked to enough people who've done this to know I'm not the only one who sat there and just waiting for the fireworks that never showed up. What most people find isn't excitement, it's rest. And rested people make better decisions. Unstressed people don't make panic purchases. That triggers a massive shift nobody warns you about, your relationship with your job. The job hasn't changed, same cubicle, same boss who thinks synergy is a personality trait, but the psychological contract between you and that boss? That is fundamentally dead now. Think about how many career calls you've made with your mortgage sitting in the back of your head, like a hostage negotiator. Staying in a job you outgrew because the timing wasn't right to take a risk. Tolerating a manager you didn't respect because that income was non-negotiable. When the mortgage dies, the financial floor drops through the basement. Sure, you still need an income. Life isn't free. But the average mortgage in 2026 is around $2,400 a month. That's a massive anchor. Without it, work becomes a choice in a way it hasn't been since you were 20. It doesn't mean you quit tomorrow. It just means your tolerance for corporate nonsense goes to zero. I've watched people negotiate raises they never would have dared to ask for. They take sabbaticals. They leave jobs they were quietly miserable in for years. Before the payoff, you're playing defense. Can I afford to do this without losing the house? After, you're playing offense. The question becomes, what do I actually want to build? Let's look at the numbers. And I promise, this is the good kind of math. Specifically, what happens to your financial skeleton the month after that last check clears? The most immediate change is the floor. Every household has a survival number, the bare minimum to keep the lights on and the fridge full. The mortgage is usually the heaviest brick in that wall. When that payment vanishes, your risk profile changes instantly. Before the payoff, losing your job is a crisis with a ticking clock. The bank doesn't care if you're unemployed, they want their $2,400. After the payoff, losing your job is still stressful, but the house isn't on the line. That is the difference between an actual emergency and just a serious problem. One threatens your existence, the other is just a situation you navigate. And then there's the investment side. This is where the real quiet wealth happens. Look at it this way. If you take that $2,400 payment, money you are already paying, money you are entirely used to living without, and you pump it into a diversified index fund at a 7% average, in 10 years, you're looking at over $390,000. In 15 years, you're pushing $730,000. That's not manifesting or vibes. That's just compound interest doing its job while you sleep. The secret is that this money doesn't feel like new money. Your lifestyle already doesn't include it. Redirecting it doesn't require discipline because you never had the money anyway. It just takes one decision, one automated setup, and you're done. I wish I'd set that up before my payoff day. Because the stretch between the last payment and actually deciding what to do with the cash is the danger zone. Money that's available has a funny way of finding its way to Amazon or Target. There are two traps that catch almost everyone, and they usually come dressed as common sense. Trap number 1, the illiquidity trap. Your house is a real asset, but you can't buy a taco with a window pane. You can't hand the hospital a piece of your drywall to cover a medical bill. That equity is locked in the walls until you sell or borrow, and both of those moves are a headache. Some people get so obsessed with burning the mortgage that they dump every spare cent into the house. They cross the finish line house rich and cash poor. The house is safe, but they're one broken transmission away from a credit card crisis. You have to build your emergency fund and your home equity in parallel. You need cash in the bank and bricks in the wall. Trap number 2, lifestyle inflation. The month after the payoff, the renovation conversation starts. The car suddenly feels too old. The vacation you skipped for 5 years feels earned. Look, you should celebrate. Buy a nice steak. Go on a trip. The disaster hits when the celebration becomes the new baseline. When that $2,400 gets slowly absorbed into a nicer version of normal life. I know a guy who paid off his $280,000 house, then immediately dropped $45 on a kitchen, leased a new car, and started eating out 3 times as much. 2 years later, he felt exactly as stressed as he did when he had a mortgage. The weight didn't go away. He just traded a mortgage for a car payment and a bunch of fancy restaurant receipts. The payoff doesn't protect you from lifestyle inflation. Only your intention can do that. Now for the stuff that's about as exciting as watching paint dry, but will ruin your life if you ignore it. When you have a mortgage, the bank handles your escrow. They take a cut of your payment and pay your property taxes and insurance for you. They're basically your financial parents. The day the mortgage closes, you're an orphan. Nobody is going to call you. Nobody is going to remind you. The bills will just start showing up at your door, looking like junk mail. If you've spent 20 years not thinking about taxes, you will miss the bill. And that's how you get massive penalties, or in extreme cases, a lien on the house you just finished paying for. That would be a pretty embarrassing way to lose a house you actually own. The fix? Spend 30 minutes this week. Set up auto-pay for your property taxes on the county website. Call your insurance company, tell them the bank is out of the picture, and set up direct billing. Do it in the first week. Don't be that guy who forgets. While you're on the phone with insurance, do an audit. Banks require specific coverage to protect their money. Now that it's your money, you can review the policy. Many insurers give mortgage-free discounts. Owners with no debt usually take better care of their homes, and the insurance companies know it. Ask for the discount. Finally, the paperwork. The lien on your property doesn't just vanish into thin air. Your lender has to file a satisfaction of mortgage with the county. Most banks do this in 30 to 60 days, but some are, let's just say, less than efficient. Demand 2 things from your lender: the certificate of satisfaction and your canceled promissory note. The promissory note is the paper you signed, saying, "I promise to pay you back." Getting it back, marked canceled, is a huge psychological win. It's the death certificate for your debt. Check your county recorder's site after 60 days to make sure it's official. Keep copies of all of it in a safe. You do not want to be hunting for this in 2040. Here is your 3 plan. Make these decisions in this exact order. Automate the redirect. Do this before the payoff happens, if possible. Send that former mortgage payment straight to your investments. Do it before your lifestyle has a chance to realize there's extra cash lying around. The insurance and tax audit. This is infrastructure. 30 minutes of work to protect decades of effort. The celebration budget. Be honest here. Decide in advance what you're going to spend on a party or a renovation. Give it a hard number. Put it in a separate account. Spend it without an ounce of guilt, and then hold the line on everything else. The reason this order matters is simple. It stops the leak. The investment redirect stops the inflation. The audit stops the taxes from lapsing. And the celebration budget lets you actually enjoy the win without it becoming a permanent, expensive habit. The freedom is real, but it doesn't manage itself. What you do in the 90 days after that final payment will decide your financial future more than the payoff itself. The payoff gives you options. It doesn't choose for you. Most people spend years staring at the spreadsheets and counting down to the payoff. That's what gets you there. But almost nobody thinks about what comes after. The mortgage was a structure, it was a cage, but it kept you on track. Now you're the one in charge. You have to be your own bank. You have to make the calls, intentionally. The quiet you feel on that last day, it's a gift. Protect it. Don't fill it with noise immediately. Automate the money, handle the papers, set the budget. The key is in your hand. What you open with it, that's entirely up to you. I'll see you in the next one.